Welcome to The Explainer. Today we're taking a look at the essential rules that protect retirement funds all around the world. It's a standard called IAS 26, and really it's all about making sure we can trust the numbers behind our retirement security.
Okay, just think about this for a second. We're talking about trillions of dollars, people's life savings all sitting in these retirement plans. So the big question is, how do we actually know if those funds are healthy? How can anyone be sure that a promise made today will be a promise kept 30 or 40 years from now? You need some kind of universal standard, a common set of rules.
And that's exactly where IAS 26 comes into the picture. It acts as that common language. It's a single rulebook so that a pension plan in, say, Japan, can be understood and judged in the same way as one in Germany. Everybody's playing by the same rules.
Now, the most important idea in IAS 26 is this. The retirement plan is its own separate thing. It's not part of the company that sponsors it. And that's a huge deal. It means the plan's finances have to stand on their own 2 feet, completely separate from the company's daily business. The plan's money is the plan's money, period.
So what is a retirement benefit plan anyway? Well, at its core, it's simply the formal promise a company makes to provide you with an income after you retire. It could be a traditional monthly pension check, a one-time lump sum payout, you name it. It's the arrangement for that post-work income.
And who is this all for? The standard calls them participants. But listen, this isn't just the people currently working and paying in. It also includes retirees who are already getting their checks and anyone else who has a legal right to benefits. This whole standard is really about protecting them.
Okay, this is where it gets really interesting. IAS 26 knows that not all retirement plans are built the same. In fact, they pretty much all go down one of 2 very different paths. And understanding this fork in the road is honestly the key to understanding the whole thing.
So here's that fork in the road. On one side, we have defined contribution plans. Here, what you get out depends on what went in and how the investments did. On the other side, we have defined benefit plans, where your employer promises you a specific, predictable payout. It really all boils down to one simple question. Who's taking on the risk? In a contribution plan, you, the employee, are. In a benefit plan, the employer is.
All right, let's go down that first path. The best way to think about a defined contribution plan, like a 401k if you're in the US, is like your own personal savings jar. The whole idea is pretty simple.
The process is really straightforward. First, money goes into the jar from you, your employer, or both. Then that money gets invested, and it goes up or down with the market. And finally, when you retire, you get whatever is in that jar. If the investments did great, you did great. If they didn't do so well, your final benefit is smaller.
And for the employer in this setup, their responsibility is super clear. Once they've put their agreed-upon contribution into your savings jar, their job is pretty much done. They don't guarantee you a certain outcome. They only guarantee they'll make their regular payments along the way.
Now, let's switch gears and look at that second path because it is a completely different world. A defined benefit plan is not a savings jar. It's a binding promise. It's the employer promising to pay you a specific amount of money when you retire, often for the rest of your life.
As you can imagine, this creates a massive challenge. How on earth does a company figure out how much money it needs to have right now to pay for a promise that might not come due for another 30 or 40 years? You have to make all these assumptions about how long people will live, how much salaries will grow. It's incredibly complex.
And of course, there's a technical accounting term for this. It's called the actuarial present value of promised retirement benefits. Yeah, it's a mouthful, I know. But all it really means is trying to figure out the lump sum of cash the plan would need today to cover every promise it's already made to its employees for the work they've already done. And because this is so complicated, these plans need to bring in an expert called an actuary. You can think of actuaries as financial fortune tellers. They use all this math and data to check the plan's health and figure out if the company is putting enough money in to make sure that future promise is safe.
So how do you report this giant estimated number? Well, IAS 26 gives plans a few options. They can put it right on the main financial statement, showing whether they have more than enough money, a surplus, or not enough, a deficit. They could also just mention it in the footnotes. Or they can point to the detailed report from that actuary. But no matter which way they do it, the information has to be disclosed. There's no hiding the ball.
Okay, so we've looked at the 2 very different types of plans. But what about the rules that apply to everybody, no matter what kind of plan it is? IAS 26 lays out some fundamental ground rules for transparency that everyone has to follow. The biggest, most important rule is this. All the plan's investments have to be reported at what they're worth today. That's their fair value. You can't use the price you paid for a stock 10 years ago. This gives everyone the most honest, up-to-date snapshot of the plan's financial health.
The standard also forces them to be open about risk. For instance, if a plan puts too many of its eggs in one basket, say investing more than 5% of its entire value into a single stock or property, it has to call that out specifically. It's a way to stop plans from taking huge, concentrated bets without telling anyone. And on top of that, every plan has to give a clear picture of the money coming in and going out. That means showing all the contributions from employers and employees, all the income the investments made, and all the benefits paid out to retirees. And crucially, they have to tell you if they're investing in the employer's own company. That's a potential conflict of interest everyone needs to be aware of.
So, we've gone through all these rules, definitions, and different types of plans. Let's step back and ask the big question. Why does a dry-sounding accounting standard like IAS 26 actually matter to any of us?
Because at the end of the day, this standard is all about trust. It's the rule book that makes sure a promise about your retirement isn't just empty words on a page. It's what backs up that promise with the system of clear, transparent reporting that holds these massive funds accountable and gives you the information you need to feel secure about your future.
And that kind of leaves us with one last thought. This global standard creates the framework for accountability. But it's up to all of us, the participants, the regulators, the analysts, to actually use that information, to ask the hard questions, and to make sure those promises about our retirement can truly and safely be kept.